Hey friends, this is Martin, your mortgage guy. I just wanted to make a quick video about using your 401k funds for your down payment. I was just having this conversation with a couple of young guys I was having coffee with, and we were talking about one of them's already purchased his first home, said he took money out of his 401k. And the other one, we were talking about his 401k and how he's saving money for a down payment on a house. So I want to mention this because this is my own personal experience. And this is typically the rules for how 401ks work and what you can do with them as far as using the funds for the purchase of a primary residence. So typically, yes, that is one of the allowances with a 401k at an employer. You know, you put that money in there for retirement, and there are penalties if you withdraw the funds before age 59 and a half. That's as of today. That's typically the rule. The tax rule that goes along with 401k plans. But there is an allowance to use those funds without penalties to withdraw those funds for certain reasons. One is if the owner of those funds or a family member is planning to go to college. I believe it's for the owner, the employee, or a family member. Might also include a family member planning to get their first bachelor's degree. You can use those funds to help you pay college tuition. You also can use those funds to help you pay for a down payment on a primary residence, on a home that you're buying to live in. But there are different options with different employers. Some employers allow you to borrow the money against your 401k. So you take it out as a loan and pay it back with interest, and you're basically paying yourself back and adding more principal to your initial investment in your 401k because you're paying back that interest, and they'll automatically deduct it out of your paycheck, and it's a really small payment. They'll give you like 10 years to pay it back. But what I discovered is there is one significant drawback to taking out a loan against the 401k. And that is, so let's say you work for a big company, a big employer like a utility company or a bank or just any major employer. And you work for this company, you borrow $10,000 out of your 401k, $15,000 out of your 401k, you buy a home, use that for your down payment and closing costs. Now you're paying them $150 every paycheck for the next 10 years. But if you want to leave that company, if you want to switch employers, if you decide it's time to move to another state and you have an opportunity for a new position or a better position at another employer, when you leave the company, you have to pay them that money back that you borrowed. So I always suggest to my clients, just withdraw the money out of your 401k. Just do the hardship withdrawal. Don't bother with the loan because you don't want to get handcuffed to your employer. Now, maybe if you're an engineer and you work for a big utility company and you know your plan is to be there for 20 years, sure. But generally speaking, most of my first-time home buyers are in their 20s. They might work for a big company. Maybe they've been investing for 3 to 5 years in their 401k. You don't know what life is going to bring. You don't know if 3 years from now you want to move companies and you can't because you still owe this company $10,000 on your 401k loan. So that's my simple advice on that. That's just my opinion. My opinions don't represent any company that I work for or any other company that I may have worked for in the past. But I just want you to know, thanks for listening. That's my little tidbit for today. And my plan for the rest of the week is to do more videos on qualifying for a mortgage. What do people need to qualify? Credit-wise, down payment-wise, things like this is what we're going to talk about. Income, employment history. We're going to talk about those things over the next few days. So subscribe and give me a call anytime. Talk with you soon.